Hello and welcome to The Bottom Line Extra. I'm your host, Marie Cato. On Monday, the European Commission has released its newest economic forecast, and it doesn't exactly scream optimism. The EU's economy will expand by a mere 1.1% this year, down from 1.5% augured in the previous forecast from the autumn. What can be done to give the European economy a much-needed kick? To answer this question, I have the pleasure of speaking to Elke König, who is currently a Senior Policy Fellow of the Leibniz Institute for Financial Research in Frankfurt. Prior to that, she held many prestigious positions, including being the first chair of the Single Resolution Board in Brussels from 2015 to 2023. Hello, and thank you very much for joining us today.
Thank you. It's my pleasure. And hello to Warsaw.
So, what are your comments regarding the EU spring economic forecast? We see that there is lower growth than in the previous autumn, but there are also some positive outlooks for 2026, where the EU is expected to grow by approximately 1.5%.
To be fair, I think the most important point to stress from what Valdis Dombrovskis explained this morning is there is a lot of uncertainty, and this is the best focus they can give based on the fact that we don't really know where the US is moving in its tariffs discussion. Well, they've based it on, I think, 10 as a baseline tariff and 25 for automotive and steel and the like, but you don't really know where this comes from. And for me, therefore, the forecast is not coming as a surprise. I think it's probably realistic. It aligns with some of the national forecasts. I was just listening into your program. So it actually obviously aligns also with the Polish most recent forecast. Uncertainty is never good for the economy. So I think the most important part is to get back to certainty there. And for Europe, well, I think there's a lot of discussion about unleashing the potential of the European capital market, unleashing also our potential by reducing all the red tape and bureaucracy. So there is a lot of things we can do homegrown, instead of just focusing on what the US tariffs might look like, would be my first.
So before we get to the red tape, I wanted to ask you, to what extent do you think that the economic situation in the US will impact our situation in Europe? Because there was some talk about the US recession. Now it seems to have subsided a little bit. However, there are some fears that the bond market will explode due to the Republican tax bill, which would obviously add into the mountain of debt in the US.
I think we've seen that this before when he announced the tariffs, that the bond market reacted negatively on this. I personally would believe that the US has always been very mindful on not entirely screwing up its capital market. So let's see what's happening. What I don't believe in is the idea that with a weaker US bond market, this would mean that we can instill the euro as a leading currency. The US dollar for the next years to come will be the lead currency for all of us. But clearly, we are in a global market between whether it's China, whether it's the US, whether it's Europe. We are all impacting each other. It's very simple.
And so as the first chair of the Single Resolution Board, and just for our viewers, this is the institution created after the financial and sovereign debt crisis that makes sure that every time a bank falls in the EU, the same procedures will be applied. So SRB is the cornerstone of the so-called banking union. One of the projects to the financial markets in the EU together, so it makes it stronger. But the process is far from complete. And now we hear about savings and investments union. So there is more work to be done. Is that correct?
That's perfectly correct. I would say the cornerstone or the lesson learned after the financial crisis was establishing what we call the banking union. So a single supervisor located at the ECB in Frankfurt and the Single Resolution Board, which would take over when a bank is failing, and has actually dealt with failing banks during my tenure in the past, and successfully. So I think that part is there. What is still missing is a uniform deposit guarantee scheme and a liquidity backstop to the Single Resolution Board. This is highly technical, but it would just make things rounded up and produce a complete system. The Savings and Investment Union, which the Commission issued a paper on in, I think it was February, March this year, is something which is a bit an old discussion. It was started actually in 2014 by then Commissioner Jonathan Hill. And for all of us to be reminded, in 2014, the UK was still member of the European Union, and our largest capital market was London. But he actually said we need to strengthen our capital market, and I think it's more important than ever. CMU, as it was named then, did not really get traction. There were a lot of bits and pieces, but it didn't really add up. The largest capital market is still London or the US. And I think there the new approach is incredibly important to ensure that financing in Europe can be done by European means. To put it very simple, we are world champions in saving, a lot of those savings being in bank deposits, so low yielding, and a lot of those savings even being invested in, we've talked about US bonds in the US and other countries, instead of turning, in particular, these investments into these savings into investments in Europe.
So obviously building...
So I would wish for the Savings Investment Union, but I'm also skeptical that it will take a bit of time.
Of course. So obviously building the Savings and Investments Union is a multi-step process. But if you had the power to enact one thing that's part of this construction, what would that be? Which one do you consider to be the most important?
Can I choose two? I think.
Of course, go ahead, two.
The first one would be ease and simplify securitization and investments by institutional investors in Europe. This is a long story. And the second one, and this goes a bit to our experience from the banking union.
Can you put that in slightly simpler terms for us?
Yes, I'll try. The second one is try to establish a single supervisor for capital market infrastructure. So the bourse in Warsaw being supervised by the same institution that supervises Frankfurt or Paris or Milan, and to have one set of rules, because then I firmly believe in the market driving progress, then the market can decide where to trade. For the time being, the problem is we have more than 20 marketplaces in Europe, whereas the UK has one and the US has, if you count it, reasonably 3 for the same amount of investments.
And do you think that Europe will ever be able to achieve a similar level of financial market integration as the US?
It will take time because a lot of the rules are still national, and to harmonize, I think people have always said Europe is always best when it's in crisis. But I think looking at our financial situation, looking at the economic growth, we are not in a deep crisis, but we need to take sustainable steps to move forward. And this would be one. And I'm sure the Commission is really committed to move forward. Though the list of their projects in this SIU draft is fairly long, and I'm always getting nervous when I listen to people that say we have to do, and then you count from 1 to 20. Doesn't really mean that you get started.
Oh, that's absolutely true. And just moving on to the crux of our conversation in some ways, you recently wrote a paper with Professor Jan Pieter Kanin, who is also a senior fellow at the Leibniz Institute for Financial Research, upon the request of former Polish President Lech Wałęsa. And this paper, just for our viewers, will form a part of a book published by the European Financial Congress, which is a big Polish business conference taking place in June. And the Polish president has put forward this idea that there is no apparent correlation between capital flows and democracy indices. And we wanted to explore your analysis. Capital flows, which is the movement of money for investments, trade and business production, is in turn heavily impacted by the quality and structure of market governance. So how can global capital flows be directed to support democratic processes? And how is this in turn connected to governance?
To me, it's very important that to really foster democratic country or the democracy in countries means that you need to foster economic wealth or economic growth, and with that economic wealth of the population. And we were a bit asking ourselves, what's really driving private investors, or what would make private investors inclined to invest in a country? And it's normally risk return consideration. And here, for me, democracies have one big advantage compared to other forms of governance, and this is that they allow for a clear distribution of power and give you a stable and predictable system. So we believe that really going into fostering democracy means that you also need to foster the financial system. This goes from central bank with a clear mandate to financial market infrastructure to supervision, because all this will help for investors to have the safeguard that if they invest in a country, they can understand the rules are predictable, transparent, and as we mentioned in our little text, even if something goes terribly wrong, so your investment doesn't pay off, you know the rules about your property rights, ownership titles, and even in insolvency. So our idea is really make it a stable financial system. This should help to attract private money and to allow investors from abroad, but also investors within the country.
But is the rule of law sometimes confused with democracy? We have this association of democracy, but really it's not necessarily democracy that plays that key role, but the rule of law, that investors want to make sure that their private property will be looked after.
Me, but this is my personal take, for me, the rule of law is heavily linked to democracy. If I'm living in a democracy, I know that changes to the rule of law can only happen in democratic processes. But of course, they can turn a bit to the right, they can turn to the left. I'm not talking about political landing, it was just the picture. But in a democracy, you have the basic belief that the rules are fair and they don't fall off heaven.
How can global capital flows be directed to support democratic processes in a sort of direct way?
I think the global capital flows, if you don't talk, if you have, I'm always focusing on two ideas. The one is private money. The other one is money, for example, from international development banks and the like. I think the support should always be an indirect support into investments in a country, and with that generating employment and wealth for people. It's not about you buy something and then you get as a return democracy. You support democracy by helping the country to achieve its goals.
And also, just one other question. Just to clarify, so Wałęsa is suggesting that poor governance won't deter capital flows, but that good governance won't necessarily attract it either. Is that correct?
That's correct. That would be my feeling. You can't ever exclude that someone says, I don't care for democracy. I invest in the country because I think the returns are just fabulous. But a longer term sustainable investment means that you have got a governance system, that you've got rules around it that make it attractive to invest.
Okay, I think now we have to definitely end our lovely conversation there. Elke König.
It was a pleasure.
Absolutely, Senior Policy Fellow of the Leibniz Institute for Financial Research at the SAFE Policy Centre in Frankfurt and first chair of the Single Resolution Board in Brussels. Thank you so much for joining us. It was a real pleasure.
Thank you for having me.
And many thanks for joining us for the Bottom Line Extra. Don't forget to join us for our regular episode of The Bottom Line at 5:10 CET on weekdays. And in the meantime, for the latest in regional business, follow us on X and on tvpworld.com. Goodbye.